In November 2020, I experimented with the magic formula and acquirer's multiple to buy 4 different stocks. The performance of these stocks were astounding, with 2 of them more than doubling. The 4 stocks are LEU that did 182% in this period, Pump that did 109% in its period, XNet that did 74%, and ASMB, which is the only losing stock that did minus 26% in that period. I picked those stocks in less than an hour using the magic formula and acquirer's multiples formulas. In this video I will cover what these formulas are, why they performed so well for me this year, why they haven't performed well for the last 10 years, and why I don't choose to use this kind of approach using formulas going forward with a long-term investing. So let's start. What's up investors, Sneers here. In this YouTube channel I cover everything about intelligent investing for the individual investor. If you are interested in this kind of content, hit the subscribe button below to help this channel and follow my content forward. For more content and tools about intelligent investing, including a written article about the content in this video, there is a link to my site in the description below, so hit that to see more content. And with that, let's start. So what is the magic formula? In 2005, Joel Greenblatt published this book, The Little Book That Beats the Market, in which he lays out the formula that he calls the magic formula. The magic formula considers 2 main variables: return on capital and earnings yield. Let's go deeper into each of them. Return on capital is the calculation of how much returns a company makes for the capital invested in the company. So for example, if a company invests $100,000 into a factory, which produces goods that can be sold at $10,000, that's 10% return on capital. If, for example, the same factory would produce goods that sold for $15,000, that would be 15% return on capital. So the higher the return on capital, the better the company. And Joel Greenblatt uses this as a measure for quality companies, because as a company has a higher return on capital, at least in theory, they are better. You can see the exact formula right now on your screen. In this formula, EBIT is the earnings before interest and taxes, divided by the net working capital, which is cash, inventories, and every current asset for the company, plus the fixed assets, which are assets that are used in the companies for the long term, like the factory, for example. Next measurement is earnings yield. What is the amount of earnings a business produces compared to its price? Now that's not exactly the price you see in the market, in the stock market, because we use here the enterprise value. The enterprise value takes the market cap, the price of the company in the market, but it also adds to it its cash holdings and debt. So in case that the company takes huge amount of debt to create some earnings, it won't skew the formula. So a company that earns $10 and its price, enterprise value, is $100 has a 10% earnings yield. If the same company that sold for $100 will create $15 in earnings, its earnings yield will be 15%. So the higher the earnings yields, again, the better the company is for us. At least cheaper it is to its earnings. The magic formula uses these 2 measurements, return on capital and earnings yields, to rank companies in the stock market by who has the most potential to go further. So it takes the cheapest companies with the highest return on capital relative to that and ranks them from top to bottom. And then invest in these companies, the cheapest but best relatively companies in the market, and expecting them to grow further than the market performance. Now this story makes sense and it also checks out. You can now see on your screen the performance backtest of the magic formula. You can pause right now the video to focus on specific years, but the performance is much better than the S&P 500. A few years later, Tobias Carlyle, the author of the Acquirer's Multiple, figured out something that is both remarkable and simple. He figured out that if we leave out the return on capital measurements for good companies and only focus on the earnings yield, meaning we focus on finding companies that have deep value, that their earnings are so much better than their current price in the market, then we will get even far better results. You can now see on the screen the performance of the acquirers multiples compared with the magic formula, which again compared to the S&P 500. The results are remarkable for the magic formula alone, but for the acquirers multiple even more so. I have some issues with this kind of presentation because this presentation here that you see again in the screen, it doesn't take into account taxes, and both formulas in the formula itself requires you to sell companies regularly every year or so. So it doesn't take into account the taxes you have to pay in every time. And it skews the results because you see the huge rise it had in the 70s and the 80s, so that right now when you look at 2010 and going forward, it looks like it doesn't even close to the S&P 500 because the S&P 500 is so low compared to that, where in fact, in the last 10 years, these formulas, both the acquirers multiple and the magic formula, didn't perform so well against the S&P 500 because in this period, growth stocks did so much better than value stocks, which these formulas measure, that they just didn't do so well. Which takes me to the next issue. Both formulas are telling a story of reversion to the mean. They are building on the idea that these companies that sell so low right now, by the measurements of earnings yield, they have temporary hiccups and the market is just mispricing them to the low end. And so if you buy them, you will earn the gap that they are worth when the market realizes their real worth against the overpriced to the lower end that we are currently in. Now, to realize that, both formulas require you to buy a stock and then sell it after a year. You are not meant to hold the stocks for the long term because those formulas are not measuring companies for the long term. They can't tell you if a company is a great company, if it's a good long-term holding, or will this company eventually go to zero. It just plays on the idea of reversion to the mean. You will get the gap from the low price that the current price of the stock is to the normal price that the market will realize eventually, potentially within a year. Now, the problem with that is that you essentially in a loop constantly. You have to buy companies every year and you have to sell them every year. And you have to cut your compounding potential every year. As I said in this tweet, you can see now on the screen, selling and paying capital gains taxes is a compounding breaking event. A company that grows steadily that we don't have to sell is a far better investment in this regard. We can get into calculations of when and how it makes sense based on some assumptions, but it's futile because the magic formula and the acquirer's multiple doesn't work consistently, while investing in great companies that compound through time doesn't have this culprit. So let's say you have another 10 years that investing in the style of the magic formula doesn't work again. It doesn't matter for you if you hold great companies that compound, even if much slower than the magic formula. It will be much more lucrative for you as an individual investor because you won't have to pay capital gains taxes because you won't sell the company and it will compound over time. And moreover, if you hold companies for long term, you will get to know the companies in a much deeper way because you will read and you will investigate them for years. And so you will be able to sleep more calmly at night if there is some turbulence in the markets. If everything in the market drops by 30%, like happened in March of 2020, if you hold great companies that you know deeply, you would be able to hold and not panic selling them in this kind of crash. As Buffett said, it's far better to buy great companies at a fair price than a fair company at a great price. So let's cover how specifically I picked these 4 stocks. I elected to go with the acquirers multiple specifically, using the earnings yield, specifically EV to EBIT measurement, using any free stock screener out there in the internet. It's easy to find, just Google stock screener and you find many out there. And when I rated the best 20 companies based on EV to EBIT, filtering out financial companies that are not working out with this kind of measurement, out of those 20, I started going one by one, filtering those that look super detrimental to me. I mean, things like when the CEO and CFO were conspiring together in some kind of crime, or a company that is investigated for fraud of investors and things like that. By the way, Tobias Carlyle specifically says not to filter this kind of companies, because usually these kind of companies, they are super low priced because of these kind of things. And then when it turns out not to be that detrimental, the price spikes up back again. And by the way, every company that has low EV to EBIT, that this kind of formulas lays out, they do have some kind of problem, because if they didn't have this kind of problems, they wouldn't be in these kind of formulas that looking for deep value companies. So get that in your mind when you try to look at companies using these formulas. Most of them will be really, really bad. So after going through some companies, I picked up the 4 that I showed you in the beginning and invested some amount of money in them. And by this time today, as you saw, 2 of them more than doubled, another did more than 70%, and just 1 of them lost more than 25%. But all in all, I made really great returns on these companies. Now, I mentioned that the magic formula and the acquirers multiple didn't work so well for the last decade. Now, let's cover why that is and how we can understand better the formulas using this. Any quantitative measurement formula for investing in the market is bound to fail at some time, because this kind of quantitative formulas, especially things like magic formula and acquirers multiple that focus on one measurement, they won't perform well if the market doesn't focus on this kind of measurement. And what do I mean by that? The magic formula and acquirers multiple are value formulas. They are focused heavily on the price of the business compared to its earning, which is very close to the traditional value investing. And in the last decade, since 2010 or so, value stocks didn't do so well, especially compared to growth stocks, which led the formulas to underperform compared to the S&P 500, that its rally in the last 10 years were led by growth stocks that of course didn't appear in this kind of formulas. Joel Greenblatt himself mentions in the book that the formula doesn't work all the time. In the book, he mentions that every 4th year the formula doesn't work, and within every year, it doesn't work for 5 months of a year at least. It just so happened that it stopped working in 2010 for whatever reasons and whatever rationales you want to make about the markets that failed to reward value investing in general in the last 10 years. Another book that utilizes the quant mechanism is What Works on Wall Street by James O'Shaughnessy. In this book, he lays out multiple formulas for investing, and he shows how good they perform compared to others and make many, many rationales about them. And it really makes sense. But then after the book published in 1996, James O'Shaughnessy opened the fund that uses multiple of those formulas he published in the book. Right now on the screen, you can see the performance of these funds that O'Shaughnessy opened. As you can see, these funds failed to perform better than the S&P 500 since 1996, the opening of the funds. It was so bad that in 2000 he had to close the funds. But that doesn't answer why did it work now? And why do I decided to go into that right now and didn't do that for the last 10 years? So after the drop of the markets in March of 2020, the new rally after the Fed started printing money, it was obvious that there is some discrepancy in it. We saw growth companies and tech companies mostly going high really, really fast, while value companies, traditional value companies, didn't do as well. And it was obvious there is huge discrepancy in the market. Many people started to talk about how value investing might come back in these conditions. And so after examining these facts and seeing the stocks, the value stocks, doing so bad compared to the growth and tech stocks, and while the Fed prints money, it became obvious to me that there might be an opportunity here. And the best way to seize this opportunity, for me at least, was to try out the acquirer's multiple again, which is a deep value mechanism. But this kind of performance that I showed here is of course an outlier because of what I just described. I don't know if this kind of formulas will perform this well in the next year, they probably won't, or even if the 10 bad years that they had came to an end. And it doesn't matter for me as an individual investor, because the idea of investing in great companies at a fair price, as I mentioned before from the quote of Buffett, and by that way avoid paying taxes and compounding in a more steady way, is far better for us individual investors. And that's why I choose to focus more on that and not continuing with this kind of investing using the magic formula or acquirer's multiple. So guys, that's it. I hope you enjoyed this video and I hope you got a lot of value from it. If you like this video, please leave a like down below. It helps me a lot. And apart from that, I hope to see you in the next video. Bye bye.